All right. Well, we'd like to start off by welcoming all of you to today's webinar on farm succession planning. And we're so happy to have you joining us today. Please know that this is being recorded and we will get started shortly. But first, as your host, we want to briefly introduce ourselves. I am Jody Halligan, the Development Director for the Catholic Foundation of Southwest Iowa, headquartered in Des Moines, and I'm joined by my co-host, Michelle Brock, the Executive Director of the Catholic Foundation in the Archdiocese of Dubuque, headquartered in Cedar Rapids. We have some general information on the screen about our foundation and encourage you to reach out to us with any questions. Our Catholic foundations are community foundations, faith-based versus place-based, and separate but collaborative within our diocese. We help meet the needs of those that our Catholic community serves through sustainable funding by connecting donors and organizations. We work with these donors and organizations to help meet both spiritual and basic human needs in a manner that reflects Catholic values.
Great, thanks, Jody. So now onto the webinar. First, know for the attorneys with us, this has been approved for continuing legal education credit, and we will share that afterwards after the webinar. If you have any questions during the presentation, we would prefer that you put them in the Q&A section, not the chat. And we'll go through them as appropriate. We may save some till the end, but if it's something that is really pertinent to what our presenter is saying at the moment, we will take a break and ask that real quickly. Our presenter, Jennifer Harrington, is a staff attorney at Iowa State University's Center for Agricultural Law and Taxation. She focuses on transition planning, specifically in the areas of business entity transitions and estate planning. Prior to joining CULT, Jennifer was a partner at Buchanan, Bibler, and Gaber and Mice, LLP, a county seat practice in Kossuth County. She specialized in business entities such as limited liability corporation companies and closely held corporations. She also worked on a variety of estate plans for farmer clients. Jennifer earned her BA in Global Studies with an Economic Development minor from the University of Minnesota in the Twin Cities, and her JD with honors from Drake University while completing a certificate in Food and Agricultural Law. Welcome, Jennifer.
Thanks, Michelle, and thanks, Jody, and thanks to both your organizations for having me today. I'm always appreciate a chance to talk about what I love to nerd out about, which of course is farm transition and the finances and a little bit of the human side that goes along with that. But I really appreciate the invitation to speak, and I'm very appreciative of all of you guys who have taken your lunch hour to kind of listen to me and hopefully get some tips that can help both your clients and your community at large, right? Maybe not just your clients, but just to know that these things are out there when community members are talking and there's things to do. So without further ado, I'm going to share my screen and we can get ourselves going. Okay, does that look good for you guys, Jody and Michelle, at least? Okay, perfect. Okay, then I will start that. So of course, I'm an attorney and all of my talks have to start with a disclaimer. And that disclaimer is that basically I'm an attorney, but I'm not your attorney. And I'm definitely not your client's attorney. And so ultimately, like I'm giving you I'll give you citations, I'll give you resources, but ultimately, you have to work with your client and figure out where they fit on the spectrum, right? And what solutions are best for them and what does that mean from their tax situation. Also, I don't really dive into politics at all, but obviously when we talk about taxes and potential changes to the tax code, sometimes politics gets brought up, especially with the recent election. And ultimately, any predictions, forecasts, any comments are my own. ISU does not pay me enough to be a dean or want me to have that responsibility, it seems. So ultimately, these are just kind of what I've seen by being a practitioner in the world, ear to the ground, kind of going, being plugged in, seeing the blogs, seeing, the speakers in this last week and kind of seeing what we think is going to shake out. Here is my contact information. Also, a PDF of these slides will be made available after the presentation. So that'll be on, you'll have this contact information. I'm also very easily found on any of your web search engines of choice. If you just kind of put ISU, Center, Ag, Jennifer, attorney, lady attorney, even brings me up, I'm told. So here are some resources for you, but also for your clients, as they kind of think about transition. This is our web page. It's cult.iastate.edu for those of you who are not familiar with it. The joys of being part of a university is you get a very long domain name. But I want to just bring your attention to what we have here, which is kind of, if you scroll down kind of after the intro, there's a bunch of tiles. And the two I want to bring to your attention are tax resources and transition and estate planning. The tax resources really has a lot of Schedule F and Iowa specific kind of tax advice. And it also kind of deals with charts and tables. If you go to any of our tax schools, you can also see kind of live recordings of our teachings. But that's not necessary. Sometimes, just the information itself is out there and available, which can be very helpful. The second tile, which is that transition and estate planning, you'll go to another web page with even more tiles, but then you'll see something called download workbook. This is the work, well, I don't know. Oh, I disappear when we do it. But this workbook is something our centers put out recently that can really help producers when it comes to estate planning. It's not a bunch of worksheets. It really is a resource guide on kind of telling the difference between a will and a trust, what is probate. But then there's also a series of chapters in the middle that really go over estate tax, income tax applications of exiting a business, and also just in general basis planning when it comes to estate planning. And so they're kind of put into terms so that your producer can kind of understand and really be helpful when we talk about what goals they have, and how the taxation scheme or business scheme can fit into those goals. So with that, it's time to get into the substantive matters, if you will. And we're going to do our estate and gift tax update. I think most of you at least are aware of the situation, but it's, worthwhile to at least kind of talk about in case it's kind of slipped from your radar, because there's a lot going on. As you can see, the estate tax rate, our unified credit over time has increased since 1997. I know the estate tax, it was much more of an issue that we were planning around. This year, right? If somebody passes away this year, they have a $13.61 million exemption from any kind of estate or gift tax, right? It's a unified tax in that sense. And we had our 2025 exemptions announced a few weeks ago. So right now, the unified credit, right? So your estate tax threshold or your credit amount is 13.99 million. We couldn't up another 10,000 to get to 14 million, I guess. And in your annual gift exemption, right? Your annual gift that you can give without even having to file or eat up any of that credit is 19,000 per person. Okay. When we talk about estate tax and we talk about farmers, this higher exemption amount really is substantial, right? And so very, very few farms actually end up having to pay estate tax. So the USDA has come out with some studies that they've done. So out of, the approximately $40,000 deaths that they estimated would occur on farms, right? Operators of farms in 2022, only 305 would actually file a 706. So that means their valuations are around where they just want to make sure that they're under that threshold and no tax. And only 87 would actually have to pay tax, right? So it's not, it's a possibility. I know we all kind of work with clients that have some good net worths, right? And so are dealing and wrestling with these issues. But it's definitely not every farm client that's coming in. And we'll kind of go over the various plans of actions that we've seen, kind of because, as you all are probably aware, that credit amount is expiring soon, right? It was temporarily increased as part of the Tax Cuts and Jobs Act. in 2017. So it was at that $5 million. And then we kind of bumped it up to 11 point something. I think it was basically like 11.1. And then it's been indexed for inflation ever since, right? And so inflation has made it up to kind of that 3.99 that we get next year. But once 2026 happens, so January 1st, 2026, right now what's scheduled to happen is we're going to go back down to that $5 million threshold, indexed for inflation. So people are thinking that it'll be right around that $7 million range, right? That's kind of what is scheduled to happen, barring any other kind of legislative intervention. So what does this mean, right? If things go on as scheduled, what does that mean to the farm economy? The blue is basically people that we're going to get taxed, when the exemption amount is the way it is and is quite high, right? And then the orange is basically what happens with the higher exemption amount. And what you can really see with that is what the USDA qualifies as mid-size and large farms are still going to have a higher likelihood of actually running into an estate tax issue. But again, we're seeing, less than 10% in any of these sizes actually having to pay out anything for an estate tax. And so some of the reason for that is usually these people tend to be pretty well diversified. And so there's things we can do, right, to minimize what their taxable estate is. And we will discuss those things further on in this conversation. But long story short, right, anything that exceeds the credit amount is taxed at 40%. So it is quite a cliff, right? Like, we're good. There's no tax. Oh, we've hit this threshold. We're at, $4 million. That last 10,000 is taxed at 40%. And so now all of a sudden there's a tax bill of $4,000, right? And that was using the 2025 numbers. So because we can't, say what Congress is going to do this next legislative session, we can all predict, but if I was better at it, I'd have a more well-paying job and I'd be playing the odds somewhere else, right? If I could predict what Congress could do. So we do, as professionals, kind of need to be aware of the situation and probably start talking to families, especially families where, both spouses are still alive, that have a net worth of over $10 million. And part of that reason is just to try and get things going so that if something does need to get done, we're working in the right direction. Because this has become more and more of an issue over the last year, right? More and more people are kind of trumpeting the end of this, the sunset that's coming. They're letting people know. And so like business appraisers and other things, tax people who are really getting into the thick in the weeds of this, right? Into the true transaction and making sure, maybe doing the tax return for the entity itself, right? They're kind of getting booked up. So it's something to kind of think about when we think about, when's the time to have this conversation with our clients. Okay. The easy call, of course, is that portability, right? So each individual has their credit amount. I have my, $13 million right now. But I can also use my spouse's, if my spouse predeceases me, as long as I take proactive steps. Okay. And that proactive step is to file an estate tax return. That's Form 706, regardless of any other, right? If there's no other reason, right? Sometimes we file those forms just to kind of set valuation and kind of get that tolling limit for the IRS to challenge the valuations. But sometimes there's no other reason to file a 706, but for this portability election. And so basically, as long as, if we can make sure that portability is elected and kind of done correctly, theoretically, a couple that dies in 2024, has a $27.22 million exemption. If they would die in 2025, then we have a $28.98 million exemption, right? Before the estate tax kicks in. What's also interesting, and when we think about these families with these net worths, is that there's no clawback for pre-2026 gifts. What that means is you can gift up to this amount, and then there's not going to be tax owed on your gift when you die and the estate tax is lower. And we'll go through an example so that that makes more sense, but that's kind of what this slide is trying to communicate to you. So for example, right, well, first we're going to go through portability in the spousal example, then we'll go through the gifting example. But so for a spouse, right, the reason why this is so important. So Lucy dies in 2024, right? We have the $13.61 million exemption at play. Sid is going to be, the recipient of her full estate. Okay. So Sid elects portability as the executor, right? So he makes sure that that 706 is filed. Sid dies in 2026 after the exemption resets back down to $7 million. So current regulations allowed that her DSUI is what we like to call it, but the deceased spouse unused exemption, right, applies to Sid. And so Sid has approximately, $20.5 million exemption. Okay. If Sid does not file that 706, right, if he just doesn't feel the need to, doesn't want to, right, if Sid dies in 2026, then he only has a $7 million exemption. Okay. So it is all or nothing. It's not like, oh, if I forget to file the 706, I'll get to use the same, credit that is available when I die, right? We don't get to just double my credit. There really has to be some paperwork done in order to make sure that that portability election is made. Now, the good news, right? Estate taxes, those forms used to be due 9 months after death. But enough people were not doing it in that time frame, and the remedy to not doing it in a timely manner was to get a private letter ruling, which, if any of you have been fortunate or maybe unfortunate enough to go down that route, that it is a pricey and usually timely process to get from the IRS, and pricey from the fees that you pay to the IRS, not even the professionals involved usually. And so there is now a new revenue procedure, right, that is out that says as of 2017, well, and it came out in 2017, but now there's a 5-year basically statute of limitations after the date of death to file the 706 when the 706 is only filed for the portability election. So theoretically, in the example I just gave before, there probably is some back end paperwork that can be done so that Sid's estate could use the full exemption amount because we're within that time frame. But again, somebody's got to identify that issue. You've got to pay more advisors, right? It's more money on the back end than it is if they're proactive about it initially. Okay. The mechanics of a lifetime gift, right? If the death occurs after the sunset, any original basic exclusion during the lifetime supplants the post 2025 exclusion, right? And so that's a fancy way of saying that if you give a big gift now, basically that's okay, right? We're not going to come back and say you owe tax on your big gift that you gave because now the exclusion amount went down. Okay. If additional basic exclusion was used back before, the sunset, it should not be clawed back. And then remember, and this is just a fun little thing, a deceased spouse unused exemption will survive remarriage, but it does not survive the death of the replacement spouse. So if you get the full amount from spouse number 1, you get to keep it. You get to be there until you die, unless, of course, your spouse number 2 passes away. And if your spouse number 2 passes away and had eaten up, say, a few $1 million of their credit, now you get that second spouse with, like, say, and your credit, right? The amount you get is going to be a few $1 million less. And tax nerds like myself love to joke about how we play the game for marriage purposes to delay estate tax forever. But, no client seems to want to do that for some reason. And I think that's probably for the best, since there are a lot of other reasons to get married besides the tax purposes, as we are all aware. Okay. So what does this mean, right? This is the lifetime gift example that it's an example that I think makes this concept a little bit easier to digest. So Margie makes a $12 million lifetime gift in 2024, right? And she files a 709, right, which is our gift tax form, and applies the basic exclusion, right? So no tax owed. You still have to file the form, but no tax is owed because, again, it's less than the $13 million we have now. She's going to die in 2026 under the exemption that has reset to $7 million, right? Under the revenue, her full gift remains sheltered by the exemption, right? So it's not that all of a sudden $5 million worth of her gift is now subject to the gift tax, gift and estate tax. That's not going to happen according to what we have with the regulations currently. However, right, not all gifting is like, it only works if you do it in an amount more than the sunset amount, right? Because if Monty gives a $7 million gift, we have the same situation, but he only gives a $7 million gift, right? After the exemption, it resets back down to $7 million. He dies, right? Sometime after that reset. Okay. Any property then passed to his heirs at death will be subject to a 40% estate tax, right? Even though he could have given more and sheltered more from the estate tax, he didn't. It's kind of the summary of this example. Now, again, there's some benefit, right? If the gift value appreciates after he has gifted it, right? You're not getting step up in basis, but he's also not having to pay tax on that appreciation because it's outside of his estate. And so it's not going to be used as the value. Okay. So lifetime gifting, this becomes a more difficult call, right? And there's a variety of reasons for it. Is the step up worth it, right? We all know if you gift, you get rid of the benefit of a step up in basis. And that's a blessing and a curse in the sense that sometimes we don't even want our beneficiaries to sell. And so a low basis kind of, again, puts another barrier from that heir selling what I have given them. On the other hand, sometimes the stepped up in basis is nice because we want liquidity and we need the flexibility associated with it. And then also, the other thing, do you need those assets? A gift means you give it and no strings attached. And so you can't really like claw it back if all of a sudden a different financial situation arises, right? And you need those assets for your own living. So when is gifting not efficient? Here's a good example that I think kind of solidifies these concepts in our mind. So I gift 500 acres of land this year, right? Or this coming year in 2025. The land, we're going to say it's 10,000 an acre. So this is marginal land in most of the state, right? With some of the prices we've seen recently. But ultimately my 500 acres, is worth $5 million. I have a basis though of only 1,000, right? So I have a lot of capital gain locked into this land asset that I hold. But I'm going to gift it, right? I'm going to gift it. I claim a $5 million exemption for my gift, right? For my estate and gift tax exemption amount. Okay. And at 2026, my land is worth 5.2 million, right? Like I gifted it and unfortunately I passed away. I've saved no estate tax, right? Because none was going to be owed. And my heirs don't have the benefit of step up in basis, right? So now they have their lower basis. Okay. Sometimes what we end up is that it's really not efficient, right? Like the math doesn't math, or the math doesn't create a tax benefit, right? Like it's not worth incurring the cost because the tax savings aren't worth it. And so this is what we have in another thing, right? We now, instead of 500 acres of land, I have 1,000 acres of land, right? And so now I have a $10 million gift that I can give to my kids, to somebody, right? So I do that, right? I gift them that way. The gift is still worth $10 million. And we're going to say there's no appreciation on the land due to the current farming situation. Things have kind of stayed stagnant for 1 year. And so basically my estate tax, right? My estate saves 1.36 million in tax. We're going to assume the sunset happens in this situation, right? So, I got $3 million above my exemption amount, but right. And so I don't have to pay that, right? Had I still owned it at time, but the step up in basis is more than the tax savings, right? Had I kept on to it, had I contained it, and had I given it to my heirs through my estate plan, they would have received a step up in basis that would have that would have saved approximately 2.552 million.
Jennifer, we have a quick question.
Yes.
It says, how do they figure out the value of the gift when gifting farmland? Is it an appraisal?
Yeah, great question. I mean, ultimately, it's up to the person signing the tax return, right? What proof are you comfortable with? I would say an appraisal is much better than county assessor. But ultimately, it's what are you comfortable defending in front of the IRS as far as making sure that you put that value is truly fair market value. Because again, usually we're talking about giving it to a related party. And when we do that, we know that the IRS is going to scrutinize the value we give it a little more carefully. So if you can get an appraiser, especially a certified appraiser, I would say that's top tier. But obviously, and we'll get into this, when you get into annual gifting, that can get kind of pricey, right? And so sometimes people try and get creative. But again, it's really a risk cost, a risk. I think it's a risk discussion more than anything else. And then ultimately, if you're the tax preparer and you're signing that tax return, you've got to feel comfortable with what you have an independent duty outside of just relying on your client under Circular 230. And so you've got to keep that in mind with your due diligence and other things. But great question. And so here's where we see, where lifetime giving can be efficient, right? So now I have my 1,000 acres, but my basis was much higher, right? So there wasn't nearly as much capital gain locked in. And so because of that, long story short, I save more in my estate tax than I would gain from my step up in basis. And so that's just the calculation you need to make when we're talking about maybe getting rid of assets now and kind of preserving that higher amount. If that's a goal of your client and they're willing to be in a position like that. Because
just for a quick clarification too, one more question here that came up. You mentioned the cost would be more by not getting stepped up basis, but the heirs that receive the gift would not owe the capital gains unless they sell, correct?
Correct. Right. Yeah. So yeah, the gift recipients, and we like to call them donees, right? They receive the basis that's the same as the donor, right? And so as it's not a big deal until somebody sells. And that's a key point to keep in mind, really, especially when we're talking about farm families. But I guess kind of to this fun estate thing that we're all kind of wrestling with, and how do we have these conversations, or when do we have these conversations, and with what client? Usually when we're talking, and this is specifically about kind of this lifetime giving and gifting in order to kind of remain under an estate tax threshold. If the family's up to 10 million, and again, this presupposes that you have full credits for two spouses that are married, right? So these figures are kind of, we've got unlimited marital deduction available to us, which we always do among a married couple, but then nobody's really eaten into their unified credit yet. If they're around 10 million or less, we're not really looking at this strategy. For the most part, we're really looking at basis planning at that point. More than 27 million, we know we've got an estate tax concern, right? So we're playing around with some of these tools I'm going to talk about later. And I shouldn't say playing around, like we take this seriously, right? We plan for them, but we use a variety of tools to try and minimize taxes owed. Again, we don't try to completely avoid when we can't, but we just try to minimize under legal parameters. And then the families in the middle, that's the hard call, right? Because oftentimes gifting really significantly cuts down on the wealth available to them, right? If you are worth $16 million and you are getting rid of, $12 million to fully tap into one spouse's, exclusion amount, like that's a lot, right? You're back down to 4 million, and you might have been used to being able to bank knowing that you had this net worth and these other things. Now, again, there's ways that people handle these things, but it's a conversation to have. Valuation discounts, right? So these are another thing. Again, now I'm going to kind of talk about, how are we valuing our clients' taxable estate? and how are we really looking at making sure that the estate tax issue is addressed if it needs to be, or ensuring that it's definitely not going to be an issue. And one thing that we still do, and sometimes it just gets brought up in this conversation, of course, is valuation discounts. And this is for business entity holdings, right? These are for people who have membership interests or shareholders, right, in corporations. Basically the lack of marketability and the lack of control discounts are still available. Of course, there's no safe harbor. That's the unfortunate part. So I can't say like, oh, a lack of marketability discount of 10% is appropriate in farms. Unfortunately, I can't give you that hard and fast rule. It's something that, again, there are business appraisers if you want to feel, more secure. But then there are other families that are, more risk tolerant and are willing to kind of take kind of what they view as an appropriate discount after kind of talking to their bankers and other things. Now, again, there have been proposed rules. Occasionally we always kind of get rumors that this is going to go away. It hasn't really happened. The Green Book proposed revising or, eliminating these discounts. But of course, with the recent election, I don't know how much we can rely on the Green Book as far as guiding maybe what, well, we can't rely on the Green Book because that's for the Biden administration. And so Trump hasn't released, his version of the Green Book, and he didn't release a Green Book when he was in office. And it's not him, it's technically the Department of Treasury, but the Treasury didn't have one during his time in office. So it just kind of makes it a little bit harder to figure out where we might be going. Sometimes we talk about special use valuation, right? That's a thing. That applies to farmers. Unfortunately, again, it's kind of with people who are right at the line about whether a state tax is owed or not. It's not a tool that's pretty significant. And part of the reason why is because you really only get a $1.4 million discount, right? On some farming ground. Which in the scale, again, if you're dealing with these problems is not the valuation discount maybe you're looking for, especially when some of these farms are closer to urban areas, right? And are really in that development prospectus area. But it's capped at how much that valuation discount can give you, right? The heirs have to continue to farm it. It's got to be a related individual. So there's some strings on the back end. And so ultimately you'll save about $500,000 in tax owed if you go down that route. In 2025. Conservation easements, right? So conservation easements in general, permanent and 30-year easements, like the sale of property. So you reduce your basis in the property by the purchase price of the easement. And so there's more about how you'd actually file that on the tax form, but that's typically how conservation easements are treated under the tax code. And that's just, again, those are kind of your generic conservation easements, right? If you have a qualified conservation easement, which is defined under the tax code, you could, there's special rules that apply to farmers that allow them to kind of apply it to their AGI in a much broader sense and under much more favorable terms than it does to non-farmers. Now, a qualified conservation easement can be to keep it in for agricultural purposes. It doesn't necessarily mean that you have to let the land go to fallow. And that's just something to keep in mind. Now, again, plenty of organizations work through that with farmers as well. And then there's another fun conservation easement when it actually comes to gross estates, right? And when we talk about valuing the estate. And that's the one that basically you can get a 40% reduction in the fair market value of the land if it's encumbered by a qualified conservation easement. Get up to a 40% discount on the fair market value. But usually we run into a different limit before that 40%, and that is the $500,000, right? So again, you're only going to discount the gross estate by $500,000 if you are in this situation. And a lot of times you're tying up ground for other purposes, right? And sometimes even like other farming or agricultural adjacent purposes. So it's something to keep in mind, right, when we talk about, flexibility versus tax implications in the situation we're in now. And with that, that gets me to the charitable remainder trusts, which I know is kind of a topic we really wanted to dive into today. So I'm gonna probably hit these probably in much more detail than some of the other stuff that we've talked about so far. But I guess I will take a quick kind of like pause and see if anybody has any questions real quick about the conversation that we just had. I know that can be a lot, but it was basically the estate tax kind of unified credit, and then some value, some farmer specific gross estate valuation things we see.
I will see if there's any questions that pop up in the Q&A here, but other than a general one, will a copy of the slides be available? Yes, they will be. We'll get those to everybody afterwards.
Okay, perfect. Well, and I needed to take a sip of water, so I was a little selfish myself, I'll admit that. Okay, so with that, we're gonna go on to charitable remainder trusts. Okay. These are typically used when people are looking at a big tax event, right? Either from the estate tax perspective or even from an income tax perspective. And it's a way to kind of, we'll go through the mechanics of them, but that's typically the situation we see, right? Like there's kind of a big taxable event. And so they're going to utilize a code section 664, right? Internal, the IRC, in order to kind of get a tax benefit and benefit a charity at the same time. So like I said, in general, right, it's highly appreciated property or property that would trigger high tax liability if sold. So sometimes we do see this with ground, but we also see this with depreciation recapture property. So that would be like your machinery and your equipment. So a retiring farmer, right, a farmer holding a large amount of stored grain or machinery, a farmer liquidating a dairy herd or farmland may be able to use some of these, may use this trust to spread out income across tax years, right? So they're still going to owe tax. It just might be at a lower rate. Overall, so lowering their overall tax liability and also benefiting a charity, right? So charities do get something for sure at the end of this, right? They usually get donations and they can help your client along with this process. And so that it's a great system and mechanism. But it is something to just keep in mind that, it's a while sometimes before the charity actually gets the money. So the basic tax advantages, right, is it allows appreciated assets to be sold immediately without a tax bill, right? Taxes are deferred. And sometimes this is to facilitate portfolio diversification, right? Oftentimes we are taking either grain or equipment and we are converting it in a large way to stocks, right? Or an annuity. So that's just something to keep in mind, right? We are changing what we actually have and the risk associated with what we have in a lot of ways. It may provide a charitable donation tax benefit in the year that you make, that basically you donate to the trust. And we'll go over that may in further detail in a few slides. And then it also does provide some control over when the funds in the trust will be distributed back to you. And it's not all the funds, right? Like, again, the charity does receive a benefit from this, but you do get funds back to you, right? And again, it is established by Internal Revenue Code 664. And so that's the provision that authorizes this special tax treatment on these types of trusts. And so obviously there's going to be some documentation within the trust itself, and obviously some conversation between the tax preparer, the attorney, and the charities to kind of just make sure that all the provisions of 664 are being followed. Because if not, then we're in a sticky wicket when it comes to the tax situation. So a lot of the times we don't just see CRTs, right? We don't see that. We see CRATs, CRETs, and CLATs. These are grouped together. They're all charitable remainder trusts in some ways, right? Your CRAT, your A stands for annuity, right? So whatever you are gifting to the trust, right? ultimately is going to get sold and goes into purchasing an annuity. Well, typically is sold, right? And it's going into a portfolio from which you are guaranteed a payment from through an annuity stream. Okay. It can be from 2 to 20 years, or it can be for the grantor's lifetime, right? Those are kind of the provisions. Again, 664 really dives into the details, of how the distributions have to go, what percentage needs to be distributed, right? Like there are a lot of parameters on these trusts themselves, but the charity that you work with usually is aware of those and will make sure that those parameters are being met. CRUT is for unit trust. And so instead of a set annuity stream, so a set amount that we know is coming out every year, it's a percentage usually of the principal or the corpus that's going to be given to you every year, right? And so that amount will change kind of depending on how that portfolio is doing inside the trust. A CLAT is a whole different tax strategy in a lot of ways. I do not see this being used by farmers, but I will put it in here because it kind of gets there. And that is a lead annuity. And then so that in a lot of ways is where the charity gets paid and then you get a payment down at the back end, right? The grantor gets a payment down at the back end. And again, that's kind of a weird flipping, and it usually is not what we're seeing farmers do, because they're looking for that revenue stream after they form this, right? They're usually wanting that kind of retirement income. So this is kind of, again, this is a very, very simplistic example, but it kind of gets into kind of the basic math principles at play here, right? So we're going to say that at the end of 23, Rodney retired from farming, right? He had $1 million in fully depreciated machinery, and he had grain on hand that he wanted to sell, right? So between the two, it's $1 million. It's not, anyway. And so if he sold the property outright, right, at that time, and still kind of under current tax laws, he'd have about $400,000 in tax, in income tax that year, right? Because of the depreciation recapture, and then just also the zero basis in the grain, most likely. And then so he still has 600,000, right? That's liquid at that point that he can invest and he can live off of. And that's nothing to sneeze at, right? Like that's a great strategy and that works for some people. However, if he was charitably minded, right? Maybe to a Catholic diocese, maybe to ISU, maybe to, whatever organization, right? They so choose. Again, that is a 50C, 501C. At that point, right, he can maybe do this, right? And so he can give that stuff to the charity, and he could probably get an annuity payment every year that's pretty close to about $100,000, right? And he would basically be giving the charity $100,000 gift, right? That's kind of what the tables say the value of that gift is. So how are the mechanics of this, right? Like how does this truly work from a soup to nuts kind of situation, right? And so a farmer works with an attorney to create the trust. Usually the charity is involved in this situation as well, right? Mainly because they're more familiar than most county seat practices, right? If you are working at like a larger firm, right? One that has like a true like trust and estates department that's like 5 or 6 attorneys big, they might not work with your charity as much. But if you're kind of using more of your quote unquote local attorney, they'll probably be working with the charity at this stage. But ultimately,
Jennifer,
yes.
Quick question then. Someone asked, once established, can one change the beneficiaries of the CRT?
That is a great question. My understanding is no, not without like significant hurdles, but I will do a little bit of research and making sure that's correct. I think I did some research on that about a year ago. And I can't recall. There is some nuance, but it's definitely difficult. And then this is a little bit in the weeds. Then there's some people who are trying to play around with what we call a trust protector role. And possibly that could fit into that. But again, I'm going to say that's legally gray at best as far as ability to change beneficiary using that method. And I think the intention under the law is that you do not, right? It's an irrevocable transfer. You have gifted it to the trust and you don't have control afterwards, is definitely the intention of the law. Great question though. So, the trust gets set up, right? The document's there. We know where it's going, right? The charity, looks it over, make sure it also feels that everything is up to date, right? Up and up, as far as meeting the qualifications for what the charity needs, right? And there can be some negotiation, but then eventually the farmer transfers the assets into this charitable remainder trust. And that is considered a gift, right? So they're putting it into a new owner, which is the trust. Okay. And they're not receiving anything in return except for kind of this annuity stream. So that is a gift, and then they get a repayment, and that's kind of that fair market value we talk about. So then they may qualify for a charitable contribution, but that kind of depends on the basis of the assets placed into the trust. Right. Then the charity sells the assets. And I put a big asterisk here because this is typically what happens when we see this. But what typically is done is that people donate stocks, right? And securities and things that are more liquid. When assets maybe are not as liquid, and I'm specifically talking about land more so than any other, grain is liquid enough, and equipment for the most part is liquid enough that the charity, it technically holds title, it gets auctioned pretty shortly after. But land, right, tends to have more feelings around it for farmers, to say the least. That's where sometimes we really see negotiations with the charity on kind of how they plan to handle the real estate, right, and what will happen in the trust. Usually, ultimately, it is sold within that first year. Okay, it's just who it's sold to and under what terms is usually where we see a lot of negotiation and control by the farmer. And so if there is a beginning farmer, or if you're willing to take maybe a slight discount compared to fair market value, there are ways to handle that situation so that we can meet multiple transition and succession planning goals. But ultimately, once that trust has those assets, a lot of the times the charity is in control of it. And there is no real control from a legal point of view and truly from an influential point of view on the grantor or the previous owner. And there's a variety of reasons for that. First and foremost being, you're getting a huge tax benefit. And so we do really need to respect the form of what this is. Then basically the trust, right, will make regular income distributions to the donor for their lifetime or for 2 to 20 years, right? And so it's like an annuity in that way. And that's kind of where we get that CRAT. And I think this visual that you see up here kind of really helps put it in my mind, right? As a visual learner, right? That is where the flow of things are happening. Okay, may have a charitable tax deduction. For those of you who have been around lawyers long enough or are a lawyer, you'll know that may basically means I'm definitely not promising you that there's any immediate tax benefit, right? You might not get that in charitable deduction, right? And the deduction is limited to the present value of the charitable organization's remainder interest. And so it's the value of the donated property minus the present value of the annuity. So if the donated property that you are giving has a basis of 0, you're having a really hard time getting a positive, right? And so that's just something to keep in mind. I will say, for those of you who are familiar with the IRS websites, right, there are certain topics that are not well documented on the IRS website and can be pretty Byzantine and complicated to navigate through and find the regulations and find new rulings. The good news is CRTs are not one of them. Charitable remainder trust is actually a really well-developed area on the IRS website. So I've put a hyperlink here for when you get the notes, but feel free, if you are interested in kind of the parameters and how those payouts work, there's some really good charts about how, those numbers that are associated with the charitable remainder trusts.
Right, Jennifer, we have a couple of questions, just clarifications. The first one is the charity is then liable for the annual payments from their own assets, not an insurance company via an annuity, correct?
It will depend basically what the charity has done with the assets, right? So if the charity sells the assets and purchases an annuity, I guess in that sense, ultimately they will be responsible under the trust document to make sure that those distributions are made. They're usually listed as the trustee
Okay. And
in
then
the ones I've seen.
and one more, that annuity distribution is taxed as ordinary income, right? Best to clarify in case I'm mishearing this.
No, and actually it makes a perfect segue into what I'm going to talk about, which is taxation from these trusts, right? Like after you do this, after you formed it and you've kind of created this stream, how is that taxed back to the producer or back to the farmer? And that's a perfect segue. So thank you, Jody.
I guess we have one more.
Oh, okay.
All right. Does the gifter have any say in type of annuity purchased, or is that up to the charity?
So that would be a negotiation with the charity. But I mean, again, ultimately, it kind of just gets down to the power dynamics of like, I have the stuff and I want this trust to be written this way, right? And then we go from there. So it probably depends on the charity, right? Some charities have their set people who they like working with, and that's who they feel comfortable with for these transactions. Other charities might be a little bit more flexible. So it's a party situation, and it's hard to tell. I don't know, Jody or Michelle, you might be able to speak about how the diocese handle it, but that's been my experience. Is it's very charity by charity basis.
And I can touch on that toward the end of what we do.
Okay, cool. So for your clients, I know you guys are all the people who are here today are not the people who are out there like promoting things. Like they know that there's taxation on the back end. However, that's not everybody, unfortunately. And in 2022, we had a tax court case about these, right? So an Indiana farm couple were encouraged to kind of transfer $100,000 bushels of corn, and 100,000 bushels of soybean into one of these annuity trusts, right? And they received a yearly annuity payment. And as part of kind of them doing this, they were told, oh, you transferred into there. There's no tax upon the transferation, right? Like, so you don't get an immediate tax benefit, but the income that comes back to you will be tax free. Because it's basically you just getting a return of corpus principal, right? Just you're getting trust principal. And long story short, the tax court said, no, that's not how that works. That's not how the taxation scheme works under trust and, under the code sections that deal with trusts. In general, things that come out are ordinary income to the beneficiaries, right? To the recipients of this. To the extent it's undistributed, right? If there's capital gains holding by the trust, right? It's a flow through in some ways on the K1. So what the nature is in the hands of the trust is the nature that it's going to be in the hands of the beneficiary. So that's kind of an oversimplification in some ways. But really, most of the times it's primarily ordinary income and usually maybe a little bit of capital is what we'll see when we get the K1s at the end of the year. So again, in kind of, when they donated their corn and soybean, the tax court made it very clear there was no deduction for the contribution of grain, right? Because it had a zero basis. And then also any deductions for contributions of long-term game are subject to the 30% limit, contribution base limit. And again, there's really great advice and procedures and examples on this issue, surprisingly, for the IRS. So I would take, if you have a client and you're not sure, it's getting kind of sticky, it's worthwhile looking at those regulations and really seeing where you think your client fits in there. So long story short, we all know and we've seen these things. The employee retention credit was another one, right? If it sounds too good to be true, it probably is, right? Same promoter, same scheme. Again, it's sometimes fun to read tax court cases, right? The Gain Disappearing Act is attributed to the CRAT is worthy of a Penn and Teller magic show, right? Which means that, in the court's eyes, this is pretty egregious, right? Like taxpayers should know that in general, you cannot defer tax for forever and also receive income in some ways, right? There's usually a taxable event in that situation. Not always, but usually. The other thing, that the IRS is going to go after more and more, and just to be aware of, right, are our monetized installment agreements and Section 433B trusts. The Section 433B trusts are like intentionally defective grantor spendthrift trust. Like it's one of those like I think there's like 7 letters involved with that one, if I actually had to count through. But that one again is one where again people are trying to put it in tax without a taxable event and also get it out without having to pay income or without having to pay income tax on what they receive out, right? And in general, one of those events usually has to be taxable. The other thing, right, for families, especially if there's really no health concern kind of coming up, but we know that there's kind of this net worth being valued and staying within the family, and we're growing and it's becoming more of an issue, right? The annual exclusion gifting really is a great one, especially if we have 5 years. If we have 5 years to really plan, gifting can be a great way to not use any unified credit, and really to start getting mom and dad used to maybe not being as in control of everything. Again, it's got to be the right situation, right family, but it can be a really great one. So the annual exclusion amount, right, is 18,000 per person right now. So a couple can give 36 to any individual, right, without having to file a 709, without having to like incur any kind of eating up any of their credit, that fun stuff. Gifts of fractional interests of LLCs are possible, right? But again, best practice is to get a business appraisal, or at least kind of have a solid foundation and why you think that amount that you're giving them is worth less than the annual amount, right? And it's not a gift that eats up the exclusion. It must be a present interest gift, right? So the donee must benefit from the gift. Okay, so present interest means that it's vested, right? Like there is some financial benefit in some ways to what you are giving them. So it can be a future interest in land, right? A remainder interest in land. So, you keep a life estate in the land and they eventually will get to own the land. There's still some financial benefit to knowing that you will own in the future, right? So that is a present interest gift. And I know that trips some people up, but the actual giving of a remainderment interest is a present interest gift, and that there is a value to being a remainderman. And then also another thing to think about, right, is you can, without eating into your credit at all, you can pay people's medical bills and tuition. Now it has to be paid directly to the hospital or paid directly to the provider or paid directly to the university or the schooling institution. It's got to be an accredited institution. But you can pay for other people. And again, that's not going to eat up your credit, right? That's not a gift that might incur tax on it. Okay. So I think sometimes you're like, oh, annual gifting, it doesn't add up that much. But if grandma and grandpa wanted to give a family of 5 $180,000, they could without eating up any of the credit, right? And so I think that's just something to keep in mind. Now, obviously, if you were to do something like this, we have the Uniform Transfer to Minors Act. I mean, I would still, meet with an attorney and make sure that we're doing this correctly and documenting things correctly so that it can't ever get challenged that, grandma and grandpa are really giving mom and dad a bigger gift. But it is fairly simple. It should not be too much of a bill.
I know we're running out of time up to the hour here, but quick question on this. Is there any tax on a cash gift regardless of exclusion amount?
Well, there would be a tax on a gift if you gave more than your unified credit and it's more than the annual exclusion amount. So if I had previously, well, for this example, right, I have previously given $13.6 million in tax, like in my past, and then I decided I was going to give a gift of $30,000 to somebody. The first 18 would be the exclusion amount, and then I would owe 40, then that 12,000, right, would be the rest of the gift amount. That would be that I've already used up my credit. So I would pay 40. I, as the person giving, would have to pay a 40% tax on that 12,000. I don't know if that, I know it's hard when I can't see people's faces if they're tracking me, but yes. So, I don't know if that answered the question, but
He said,
that's
yes,
kind of
it
where I
did. Thank
arrived.
you.
Oh, okay. That's where I arrived. Okay, this is the last slide, and then I'll let Michelle go. But long story short, possible changes. Who knows, right? We all know the election just happened. The one thing I want you to take away from this, as far as farm and transition estate tax planning goes, is that John Thune, right, who we know is going to be Speaker in the Senate, has introduced the Death Tax Repeal Act. So he wants to get rid of the estate tax completely. And he introduced a bill in 2023. So that is kind of interesting in the sense that, there's a whole system of tax where at least somebody of power really has specifically said they want to get rid of it. So we'll see where the future takes us. But that's all I have. And then you'll get a copy of these slides, but truly on the estate tax return, for the deceased farmer, there's a few just like little things I wanted you to remember about net operating losses and things that actually have a loss. We talk a lot about appreciated values and how we've deferred taxes for years, but there are operating losses that we can carry, but they are very specific to the production and the farmer's return itself. There we go. So.
All right. Well, thank you very much. We are just at the hour here, so we appreciate your presentation, Jennifer. Thank you so much. Oops, I should probably put myself back on video. Here we go. Thank you so much for your presentation on farm succession planning, and thank you everybody for attending. We hope it helps you serve your clients better as this year comes to a close and the new one starts. We are honored as your Catholic Community Foundations in Iowa to sponsor this and make connections with you. For those clients of yours who have interest in a legacy that aligns with Catholic values, we do ask you to please keep us in mind as an option. And just to quickly answer, I know from our foundation, as a Catholic Community Foundation, we utilize, we don't put our assets as collateral, if you will, for anything, for annuities or trusts, charitable remainder trusts, or gift annuities. So we work with Charitable Solutions. We definitely are at the table there, but we work with a company or a nonprofit called Charitable Solutions who can do the full thing for charitable remainder trusts, turnkey, or they can simply act as trustee if a farmer wants to keep their financial advisor as part of that process. And I'll let Jody answer for Des Moines.
And that's exactly what we do as well. We use the National Gift Annuity group to do our annuities. So, but yes, please reach out to us with any questions or thoughts and visit our website for additional information on our organizations. And we'll have a recording of this webinar available on our websites. And we look forward to hearing from you and meeting with you in the future. So thank you again, and God bless.